Welcome back to another video here at Fiscal Voyage. I'm Felix, and first I want to make sure you guys are all safe and healthy, and same with your family. Make sure you're washing your hands and all that good stuff. But in this video, we're going to talk about Kimberly-Clark, which is a dividend aristocrat that's been increasing dividends for 48 consecutive years. That's outstanding. But at current prices at $137.50, we're going to determine if that's a good price to buy. If it's to buy the shares of this great company. This was suggested by Stoylen. Thank you, Stoylen, for suggesting Kimberly-Clark for a video analysis. But let's get started. So we're going to determine, if you watch towards the end, I provide a recommendation with a buy, hold, or sell and a fair value price. So stay tuned and watch to the end so you see what's the suggested recommendation. So let's go. Okay, let's start with the stock analysis on Kimberly-Clark Corp, the ticker symbol KMB. The company is a multinational personal care corporation that produces mostly paper-based consumer products. The company manufactures sanitary paper products and surgical and medical instruments. So with that, is a perfect time the company takes advantage of this pandemic because of their need for their products. Some of the brand that Kimberly-Clark owns include Kleenex facial tissue, Kotex feminine hygiene products, Scott paper toilet, Andrex toilet paper, Walpaw utility wipes, Huggies and other wipes, and disposable diapers and baby wipes. So they've actually been increasing share prices during this pandemic. So it's very defense type company here. Fundamentals. From 2010 to 2019, revenue did not grow. It actually decreased from negative 0.8% in that time period. So it's kind of been flat for the past 10 years. Net income slightly grew, however, at 1.8% in that same 10-year period. It has a great credit rating, investment grade A from S&P credit rating score. And operating income only grew at 0.8% in that same 10-year period. However, net income for the past 5 years has an average of 20.8% increase. So that's outstanding. So they've been growing their net income. However, revenue still has been flat. Earnings from 2010 to 2019 only grew at a modest 5% rate. And the past 5 years, it has been slightly lower at 4.6%. Earnings growth for the past 5 years. We look at fundamentals. Last year they had adjusted earnings of $6.89. Net margin came in at 11.7%, which is higher and expanded versus 2018 net margin of 7.6%. So that's good there, some positive there. Return on equity is a modest 11.3%. Debt to cap is pretty high at 87% here. Currently, the company has a dividend yield at 3.12%. The 5-year average is 3.13, so it's right there with the 5-year average. This is a good indicator that I like to use, and this right here tells me that based on the dividend yield, it's kind of fair value or so, based on their 5-year average. They have a decent payout ratio of 57%. And they've been growing dividends at 48 consecutive years. So they've been growing dividends longer than I've been alive, which is outstanding. And they have a 5-year dividend growth rate of 4.7%, which is low. It's kind of beating inflation, but their most recent dividend increase was 3.9% earlier this year in January. They have a charter rule of 7.8, which is the 5-year dividend growth rate plus the current yield. Gives us 7.8, so that's very low. I like to see companies 9 for REITs and higher, or for other standard corporation 11 or 12 and higher. So Kimberly-Clark gives us a 7.8 here with charter. Future outlook: 2020 earnings are expected at $7.48. 2021, $7.74. So earnings are expected to continue to grow, which is understandable as this pandemic with the coronavirus going on. People are in need of their products, their Kleenex, toilet papers, baby diapers, wipes, things of that nature. CFRA has a projected earning growth of 6%, and doing the dividend drill return model of projected return of 8%, which is pretty low. I like to see it 9% or higher. So that's kind of negative here at the 8% level. Currently, the company goes for a PE of 19.3 with a forward PE of 18.4, which is how you like it. You like the current PE to be a little higher than the forward PE, because the forward PE is based on the expected earnings. However, the 5-year PE average is 19.8, so it is lower than the 5-year PE average, which is good here, but still it's pretty at that same level, so it's probably fair value just based on PE. If we look at the fast graph, black line is the monthly closing price, the orange line is the earnings based on a PE of or multiple of 15, and the blue line is the normal PE of 19. As you can see here, the company tends to follow the blue line for its fair price. As you can see, in between 2017 and 2018, it was under that, so that looked like a good buying opportunity. But right now it looks fairly valued based on the fast graph. If we go to the fair value price slide here, CFRA has a projected or fair price of $121, Morningstar at $119. The fast graph you saw from the previous slide, $142, Yahoo at $146, and my dividend discount model analysis at $89. This one was very low based on the other four. I used a dividend growth of 4% and 3.5 going forward, and a discount of 9%. So that's why we have a very low price of $89. Averaging out the 5, we get a fair price of $123. Currently, the company goes for $137.50. So that means the company is overvalued to our fair price by 9.9%. With that, I have a hold recommendation for Kimberly-Clark. I personally own this company. I bought it around $100, $105 a share, so I'm positive here. And I'm going to continue to hold this company for the very long future because it's a company that continues to grow earnings. Its product is a necessity where everyone continues to buy, diapers, tissue papers, toilet papers, and such. So I don't see this company going anywhere, and analysts expect continued earning growth for this year and 2021. So it's a very safe investment, but with that safe investment, you get very low return. It's going to probably be modest 8%, maybe 9% return at these prices. I like overall the company. I don't like the dividend growth. It's been slowing down for the past 5 years. Like I said, most recent increase was 3.9%. So maybe this year they increase it higher because of everyone's buying their products. So we might see a nice dividend increase this year. Modest earnings growth. Like I said, the past 10-year revenue has been flat, but earnings is increasing at 4% to 5% rate, which is pretty good there, modest. And however, I'll have a buy recommendation, or I personally will buy this company if it was 115 or lower. That this price is pretty expensive, so I'm not buying at this price, but I am continue holding my shares and continue collecting dividend and reinvesting elsewhere. So with that, that's why I have my hold recommendation. So if you have a company that you'd like to see next, please let me know the name of the company and ticker symbol in the comments. If you find this video informative, please hit the like button, and thank you for watching, and make sure to subscribe to my channel for more videos like this. And you can check out my portfolio in the link in the description below. Thanks, and stay safe.